Started today. So as we get started, a couple of logistical announcements. First, regarding group case 2.5, unfortunately it's come to our attention that one of the teams sent an email over the weekend to the TAs and myself that basically said they are having participation problems where members of their team are not participating in the group case, and how should we handle it. So what I have set up is a peer review process, starting with group case 2 or 2.5, which is optional, so that if everyone on your team, because it is a team grade, therefore it requires the entire team to participate, then you don't need to do anything, and your team gets the team grade for your group exercises. However, if one or more of your team members did not work on the team case, then, and I'm going to extend this to both group case 2 or 2.5 or any case in the future, then you can go in here to a peer review and you can peer review that team member or members who did not participate and basically explain that to us. If one of your members of your group says a team member did not participate, we will not change their grade. But if 2 or more members of your group said that 1 or more members did not participate, then I will reduce your grade to a 0, and you will not get credit for the group assignment because it's an honor code violation of the school to actually submit work that you didn't complete. So I don't expect that it should affect many of you. I hope it wouldn't have expected to affect any of you, but unfortunately it has come to our attention from one team that they've done their best to reach out to group members who are AWOL for the assignment, and it is not fair for them to turn in work and for them to get credit. So again, starting with this assignment and all future group assignments, unfortunately, I'm going to have to continue this peer review process. I was hoping we wouldn't need one, but apparently we do. So that is your vehicle for kind of notifying us about participation issues. So again, the only time you need to fill this out is if you had a problem with 1 or more of your team members. If you didn't, don't worry about filling it out. Everybody gets the group grade or the group assignments. Okay. Second thing I'd like to mention is that a week from today, the first half of the stock simulation will be ending, and grades will then be assigned. So you don't have to sell anything. It'll be based on your relative ranking as of 1 week from today. So here's the point. If I were to look at T message MSG and was the section 201? Okay, so let's go to section, you're in 201. Okay, then what I'm going to do is I'm going to go to portfolio value, and you'll see everybody's lost money in this section. It's a tough market out there. So on a relative position, we'll basically just start out with team here, Jay Brady. Even though you have lost money, you've lost the least, so you're in first place as of today. I don't count. So you would get 5 points. A. Cohen, where's the A. Cohen team? You're in second place, you would get 4 points. D. Horowitz, right? You're disqualified, you don't get any points because you haven't made 10 trades. So this number needs to be 10. You have to have at least 10 longs in the first half of the semester. So if we did it today, you'd get a 0. But let's assume you'll make at least 2 more trades in the next week. And assuming you make the required minimum amount of trades, you would also get 3 points for being in third place. Jay Zhao would get 3 points. D. Turan would get 2 points. And D. McCresh would get 1 point. But obviously, the difference between the teams is not that great. So a lot can change in 1 week's time. Again, you don't have to sell and liquidate because, again, it's based on portfolio value, not cash position. But nonetheless, I will take the screenshot at the end of classes next Wednesday. I will post the screenshots for the 4 different sections, and basically relative ranking and portfolio value is how you are going to be judged. Yes?
There's a really close difference between first and second place, say 0.01.
Doesn't matter. It's all relative. In the real world, what was that movie, Ricky Bobby? You're either first or you're last. It's like Ricky Bobby. So basically, it's if you're in first by $1 or $1 million, you're in first. Sadly, that's the way the real world works. So this is not based on relative performance as a percentage. It's just literally it's relative performance on an absolute level.
Are there two third places?
Are there what?
Are there two third places? Because
Yeah, because I'm going to do a distribution 5, 4, 3, 3, 2, 1. So I'll give 2 threes. Okay, given the 6 teams. We have 6 teams in this section that are competing. If we had 7 teams, I would do 5, 4, 4, 3, 3, 2, 1. But we don't have 7 teams. Okay, other questions about this? As I said, everyone has made the requisite amount of trades except for this one team. Just make sure, because this is the way I'm going to judge it, total of 10 each half of the semester. And by the way, even though this team has made 32 trades, they still would have to make 10 more trades in the second half of the semester beyond the 32. Okay, so it's not 32 over the whole semester. It's minimum of 10 each half of the semester longs. So make sure you do that. And again, it's just, you can see, relatively tough market. No one is doing well this semester. Like generally the whole class, this section's down 3%. And as I said, first place right now is still down 1.3%. Now, again, relative to the market, I believe I was reading this morning, the S&P's down, what, about 6% from its highs. So, I mean, relative to the market, you're actually doing relatively well. But nonetheless, it's been a very tough market the last 30 days. It's reflected in these scores. Okay, the other thing I want to mention is that, and I'll leave this up here for a second. So the midterm is coming up 2 weeks from today on Halloween. And just a word of warning about the midterm. So this midterm, too, will be basically all essay questions. It is qualitative. So where the first midterm was quantitative, you had to solve for things, this one is going to be much more testing your understanding of the things that you have solved for. It will cover any content that we've covered in the first half of the semester, anything in the book, anything in the lecture notes, anything talked about in class, anything in the homework assignments is fair game. But nonetheless, it'll probably be 5 or 6 essay questions. You'll have 90 minutes to do it. You'll have it, to, again, do it during class time, and you'll do it on Halloween through ELMS. Okay, so just let you know, heads up, that is coming up in 2 weeks. Okay, questions about the midterm or anything like that? Yes?
Take it anywhere?
Yeah, again, it'll be click on the midterm from an internet location. You have 90 minutes to take it. And it's open book, open notes, open computer. Caveat, it's individuals. You can't like IM, chat, text, no social media, and you can't do it as a group. It's individual midterm. But other than that, you can take it outside of class. Okay. Other questions? All right. So the other thing is today we're going to talk about group case 2.5, the Boeing fix, and next week we're going to talk about multiples. So as part of homework 7, which is due on Monday, which is going to be an individual assignment, it'll also include both the fix and the introduction to the multiples. There will be one more multiple assignment, homework 8, which will be due the following Monday, and multiples will be part of the midterm. Okay? So that is all coming up soon in terms of content in advance of the midterm. So 2 individual homeworks, then we'll go to the midterm as part of our upcoming assignments. All right, so let's talk about group case 2.5 and Boeing and the fix. So first of all, did everybody identify the missing field? What was it? It was unbilled revenue, right? Which is something that Boeing has that other companies do not. And does anybody know where unbilled revenue comes from? Yeah.
Is it because when somebody says they're going to buy planes, they don't actually like pay for them?
It's sort of close to that. It has to do with, go ahead.
I would say like when they have the backlog.
It does have to do with their backlog, and it's kind of unique to either construction companies or Boeing, which is why it's not common. But if you actually do a search for it, because I did myself, it really generates from what's called percentage of completion accounting. Okay, so the idea is that what Boeing has to do with their planes is they make a guesstimate of how far into the process they are, percentage of completion, with their project, because they're spreading their costs out over time. And so they might say 60%. So based on that guesstimate, they then say, okay, client owes us 60% of the revenue for the contracted sale, but we haven't invoiced them because the airline, think Delta, American, whoever, isn't going to actually pay for the plane until it's finished. Okay, so I can't invoice them for the plane that they've contracted for until I actually ship it. Then it becomes an account receivable, and it's not inventory because I'm saying that part of it is actually what they're what belongs to them, percentage of completion. So it's this kind of hybrid category that sits between inventory and sales that basically is what they call unbilled revenue. And so again, it's a percentage of completion. When I get to 100% complete, the unbilled revenue moves over to accounts receivable, and then I actually claim the revenue. All right, but here's the point. So it's not common. Like this next assignment you're going to do is on Coca-Cola. Coke doesn't have unbilled revenue. All right, we did Parker Hannifin. They don't have unbilled revenue. Most companies don't have unbilled revenue, so it's kind of unique. And that's why we kind of ran across this with Boeing, because our model, even though, again, I thought this is exactly what I was talking about Bloomberg and the standard statements. Bloomberg has these standardized statements, but they put unbilled revenue in Boeing's standard statement, but they didn't put it for other companies. So, and here's what's interesting. I looked up Airbus, and Airbus doesn't have unbilled revenue. So apparently under IFRS accounting, this is a Boeing thing under US GAAP. It's not Airbus under IFRS. So it's kind of unique. Again, it's generally more construction firm related. So I might see it with a construction firm, but nonetheless, that's where it comes from. And more importantly, we got to solve for it in our models. And I'll make a general commentary about this, which is I know you hate the process this semester of balancing economic statements, and this was accidental, but this is why it's valuable. Because if we didn't balance the statements, we wouldn't have picked up that we had something missing. And when you see that when we fix it, it will dramatically have an impact on the valuation. Okay, so nonetheless, this actually helps preventing you from making real world mistakes that would have been really easy to miss if we had just done a free cash flow and we didn't do the other side of the statement. And we would have left out about $13 billion worth of invested capital that otherwise we wouldn't have even known that should have been there. So it was actually a good exercise to kind of reinforce one of the major reasons why, even though it's a pain, why we do these balancing statements. So how do we handle this? Well, we'd have gone to Boeing, and under FA, what you should have done is you should have gone to your custom model template. So here was our model template. And the last line of the model template, you could have added here at the field. We would have identified that it was unbilled revenue and added it to our template. Okay? So then when you export to Excel the template, the last row in our template should be the unbilled revenues. Okay? Now, again, very important, we got to get rid of the dashes. So find, replace all the dashes with zeros. So we've had to make 38 replacements. And this would have been file, save as, downloads, our Boeing data file. Okay? So that when we fix the model, copy this, go into our model, and basically when we paste special values the data in, then now we have the data such that row 81 now has unbilled revenue. Okay? And so the next thing is, this is a balance sheet item, so we'd have to hook this up to our balance sheet. And so the question is, where in the balance sheet do we put it? And so what I would suggest is that we put it between accounts receivables and inventory, because it's basically, it's not inventory because it's beyond the inventory, right? Because it's inventory that's being billed, but it's unbilled to the customer. It's not yet a receivable, so it's kind of a hybrid between the two. Okay, so I'm going to put it here. I'll insert a row, and I'm going to put it here in the balance sheet in row 7 plus unbilled revenue. Now here's the thing. If another company, Airbus, Parker Hannifin, whoever, doesn't have it, it'll be a 0 and it won't really affect us. But nonetheless, if a company does have it, then we have a mechanism for capturing it on a go-forward basis. All right, so our unbilled revenue for 2012, and again, I'll unhide these years, is going to be from the data tab. 2012 is column C, 81. And I'll just copy this across through 2017, and that would have been our historical unbilled revenue. Okay? Yes?
When we looked it up on the same numbers, but for us it was called contracts and process.
So when you went here and you typed unbilled revenue, you didn't look up unbilled revenue?
No, so I just went through the balance sheet as stated, and I found the numbers that matched up, and it was called contracts and process.
All right, here's the real question. Was it, because it describes that, but because it's the work in process stuff that's unbilled. But here's the point. Is it this field? The column B?
No, the Excel field is called, or the number is contracts and process.
Okay. Was the same number?
Yeah, the exact same number.
Okay. Yeah, I would have preferred the unbilled revenues, but if contracts and process are referring to the same thing, I assume that that's probably okay. Okay. But in any event, the key here is we hook it up to the balance sheet. Go back to our model. Which then leads to the TFI, so I need to add it to my TFI. And so we already have current assets, current liabilities, and operating and non-operating broken out. So the real question is this operating or is this non-operating? All right, so what did we list this? Is this 1 or a 2? What is it? Does it count? Operating or non-operating?
No.
All right, so as we try and answer that question, think about it this way. Basically, when they build more planes, will they have more unbilled revenue? All right, if you're nodding your head, then it's likely to be operating, because that's the point of operating. It's recurring things that happen as a normal course of business. So Boeing is going to keep having work in process stuff that's unbilled for their planes, then it's probably going to be considered an operating account. And so therefore it's going to be part of the operating working capital. So in this case, what I'm going to do is I already have working capital here. So I'm going to basically take the working capital and add in to from my balance sheet the unbilled revenue of B7. So that would change my working capital. Okay, so again, first assumption, operating, non-operating, it looks recurring. So therefore, I'm going to call it operating, right? And so therefore, we can also see it here, even in the actual balance sheet items, because in the balance sheet items, it's changing every year. Okay, it's not like a consistent amount. So it basically says that Boeing is probably going to continue this over time. So it's operating. It's part of their operating business. And the next thing is, I got to basically put this in my TFI. And when I do, notice my TFI now balances. If I copy the working capital forward, it now balances as well. Okay? Except here's the thing. I actually want to copy it all the way through 2023, because if I'm going to fix my model, then I don't just fix the historical fields. I have to forecast this because it is operating, which means it's going to continue into the future. So I had to figure out a way to forecast the unbilled revenue into the future. So that leads to the next thing. So where do I forecast that? Well, that would come under the ratios. So what I'm going to do is I'm going to add a row between 13 and 14, insert, and this is going to be my unbilled revenue, and I'm going to do this as a percentage of sales. So if I go back to my balance sheet, unbilled revenue, which is B7, divided by my income tab, which is B12, 18.5% of sales to 14.9, it's kind of bouncing around. So that leads to the next question, which is, okay, I got to forecast the unbilled revenue because it's obviously going to continue. It's not like it's going to go away, right? So there's three things that would have happened. Number one, you wouldn't have forecasted at all, which I think would have been a flawed model. And when we give you grades, we're going to still say it's a broken model, so you won't get credit for that. So if you didn't forecast it, but you only fixed it historically, you have a flawed model. And I'll show you why it's a flawed model. Because if you were to go to your ROIC tree, you'll notice that the ROIC has now changed substantially. See, when you did your assignment, that final ROIC was 80% because we forgot to put in about 13 to 14 to 15 billion dollars worth of assets. So since we missed all that I, we had an unrealistically high ROIC. And because we had an unrealistically high ROIC, we carried that ROIC forward into our valuation, we would have had an unrealistic free cash flow valuation. So this is how the historical flaw actually continues into our model flaw. Matter of fact, that goes back to an assumption in finance is if something looks too good to be true, it probably is. Boeing have a 80% ROIC going to 100% ROIC in the future was probably unrealistic, right? And it was because we forgot about $13 to $15 billion a year of investment that they're making. And that's another thing why it was helpful to fix this, because it would have been easy to miss this. Matter of fact, I had 160 undergrads plus myself who missed this on group case 2 because you didn't write up the ROIC with the correct ROIC because none of us in our model had the right ROIC. Okay, so again, we'd have to correct this. Now, I'm not going to go ask you to go rewrite group case 2, but the point is, as part of your fix, you should know that we would have to not only fix in the past, but we got to carry this forward in the future. Otherwise, we're not going to have a proper valuation. So, as I said, option 1, you didn't include unbilled revenue into the future. That's still a flawed model, right? Option 2, what somebody said in the first section is they said, well, we'll just make it constant, all right? For this assignment, I'll suggest the TAs, if you made it constant, give you potential credit, even though I disagree that that's not the best way to do it. All right? So here's the thing. When we were forecasting the balance sheet and building the model 3 weeks ago, we left a lot of items constant. All right? And that's probably why they assumed we'll just leave unbilled revenue constant. But here's the difference. What we left constant 2 or 3 weeks ago was debt and equity. All right? And the key is, the reason we left it constant is because it doesn't change the valuation, right? If you change around the debt, if you change around the dividends, if you change around the preferred or the common stock or the minority interest, it doesn't affect cash flow, specifically free cash flow. So therefore, it doesn't change operating value. And it's really more for window dressing, right? So I said, I'll make the same comment now, like you can change it if you want to change it, but it won't affect your valuation. This, which is part of working capital, does affect the valuation. Okay, so leaving this constant will actually have an impact on the valuation because what you're saying is as Boeing grows, it won't have this sort of unbilled work in process on planes. That may not be as much of a realistic assumption. So in that case, I think I actually do want to vary it. So here's the point. Instead of leaving it constant, I think in the future it makes more sense to make it a that we can change. Now, even if I leave it at 14.9% of sales, which is what it was in the previous year, I would still want to have it be a variable rather than a fixed number because this one does affect valuation. So hence, I'm going to put it here into those future ratios. So historical and future ratios, as opposed to just leaving it constant. Questions about that? Rationale, why I did that? That'd be a good essay question for the midterm, by the way. All right, so continuing on. So now I got to make sure that that forecast is picked up properly. So even though I have a balanced TFI, I got to make sure, and you can see it right here, that my working capital forecast carries forward into the future, which means that on my balance sheet, my unbilled revenue, I need one that goes from 18 to 23. So in this case, what I'm going to do is take income, 2018 revenue, times ratios, 2018 unbilled revenue as a percentage of revenue. Let's try this again. Equals 2018 revenue times ratios 2018, where was it? 14.9, H14. There we go. And then I need to copy that and paste that forward. And then the final thing is excess cash. You'll notice that I'm subtracting assets minus everything else to solve for excess cash. Well, the everything else doesn't include the unbilled revenue that we just added. So the other thing I have to do to solve for excess cash is make sure that I subtract the unbilled revenue. and then copy and paste that into the future. Okay? Because otherwise I'm going to have an unrealistic excess cash balance because I'm not going to count the excess cash, or I'll double count the excess cash, and then I'll get an improper valuation. Okay? Questions about what I just did? But if I did it right, then I have a TFI that should balance into the future, and I should have a CFI that is not only fixed, but is also balancing into the future. Okay. And if I go back to my model, notice my share price is now 348 versus 380. So I no longer have an as is. So I kind of hinted at this in class last week that you might want to redo your as is. Well, we'd have to redo our as is because if we submitted as is, this isn't an as is model anymore. I'm now $30 off. So I can't call this an as is valuation. So I would have had to make changes to get to an as is model. Otherwise, I wouldn't have an as is. So fixing the model caused me to have to change my as is, and therefore the valuations that I do. So it has little domino cascading effects. But when we say fix, this is the fix. All right, questions about the fix? What I did, how I did it, what we needed to do, because the next piece is we're going to redo the as is. Okay, so I'll save this. Video, we'll call this our fixed as is. And we're going to do it as of the price today. So today, for Boeing, sorry, trouble with my screen here, BA US equity. I'm going to take a new DES screenshot because the price today is 366, just so you have it. So save as BA DES. I'm going to take our WACC. And I'm going to take our EEO at the time of our valuation. All right, so here's the deal. When I go into my model, the WACC has changed. This you don't see very often. 7 days ago, Boeing's WACC was 9.7%. 7 days later, Boeing's WACC is 10.2%. I don't know if everybody's been paying attention to this, but the yield of the 10-year Treasury has been skyrocketing. Matter of fact, front page headlines of the Wall Street Journal today, Trump's new #1 enemy is his own chairman of the Federal Reserve, right? So again, take out the Trumpisms, like he's upset that interest rates are skyrocketing and that's why the markets have been so volatile and falling, which is why many of you in the stock simulation are losing money, right? Because basically that big upswing in interest rates, risk-free is rising, discount rates are rising, cash flow valuations are falling. We're seeing that play out in the real world. And just to see, I'm just saying, I haven't seen this much of a change in WACC in this shorter period of time since the financial crisis of 2008, 2009. Right? But nonetheless, that's what the market has been whipsawing around. You can see it clearly here in Boeing as that cost of equity has been skyrocketing. All right, so long story short, I got to put that in my model. So that's another reason why I need to update my as is, because to some degree, I would have assumed that 7 days shouldn't matter, but here it did. Okay, so 10.2. Oh, by the way, that puts my target price down to 309. I'm even further from my current trading price, which, by the way, is the next thing I have to update. We were at 380 last week, and today we're, where was I in the DES? Where was it? Downloads. $366.45. That's the price a few minutes ago. So to do my as is, I need to be closer to $309.50. All right, let's just do a quick check. I didn't do this in the last class, but to make sure that the EEO hasn't changed as well. So EEO, what do we got here? 98,499. 98,499. It did change. 105,385. Not much, but it did change.
105.
Oh, yeah, 105. And 113,145. And the EBITDA 14,083. $15,570. 17,007. Not much, but a little bit. They did change. All right, and so again, I'm at about a $315 share price. Now, as I think about getting to the as is, we talked about it last week. We were talking about 5 variables. I don't think I'm going to change the tax rate, right? So really EBITDA margin, I think we have a better representation of the next 3 years and the growth rate. So really it's the growth and the EBITDA margin in the future and the G. Now, here's where the multiples will help us. So where we were last week is when we did G, I kind of just swagged it, right? Could have been 3, could have been 4, could have been 5, could have been 6, kind of stuck my finger in the air, saw which way the wind was blowing, said, gut feel, I think it'll be this. What I want to do today is, and this is a lead into the multiples analysis that you were going to do next week, is that in the readings for this week and in the material that is in the lecture note 6, this is the key value driver formula we have been talking about all semester, right? And here's part of it. We're going to talk about 6 multiples next week. EV to EBIT, EV to EBITDA, EV to sales, PE, PEG, and price to book, right? But what you're going to find is all of those multiples are just a derivation of this formula. So part of it is this. If I go back to this page in the book, which I've highlighted here, this is how you take the key value driver formula and rearrange it to get an EV to EBIT multiple. So this is the formula for EV to EBIT. So what you do is if you take no plat times 1 minus G over ROIC divided by WACC minus G, and you say that no plat is basically EBIT times 1 minus the tax rate, and if you divide both sides by EBIT, the EBIT cancels out here, you get enterprise value to EBIT equals 1 minus the tax rate times 1 minus G over ROIC divided by WACC minus G. This is enterprise value to EBIT academically, according to Modigliani Miller. So here's the deal. We can go into the real world and observe an EV to EBIT multiple for Boeing today, which we're going to in just a minute. We have a pretty good sense of what Boeing's tax rate should be going forward. We got guidance from the company itself. We have a pretty good sense of what the WACC is, right? Because again, with a target capital structure, generally the WACC should be representative of the future based on today. And finally, we have a pretty good sense of their operating ROIC. So if we know those 3 variables and we know the enterprise value to EBIT, we can solve for a G. Now, in a way, you did this on a previous assignment. We're just going to use that process to get a more market-based G for the as-is than a gut feel-based G, which is what we were doing last week. So we're going to back solve for a G as a starting point. All right. I'm not saying it's the final one, but at least it gets us probably a much more representative G to make the as-is model work. So let's start doing that. What I'm going to do is in the assumptions part of our model, save where we are, I'm going to come down here and for forward year 2, because we had talked about this before, but again, it's in the book. Generally, with forward year 2, multiples tend to become more normalized. So I want to look at the observed EV to EBIT multiple in the real world today. And I want to look at my model generated EV to EBIT multiple, which we'll do in just a minute. So what is our observed EV to EBIT? Well, it's actually on the EEO screen. So when you took the screenshot of the EEO screen, on the bottom half of the EEO are the current trading multiples, and the sixth one down is EV to EBIT. This is the second forward year, 2019, FY 2019. So as of right now, it is 15.89. Now, screenshots matter, and that's why I'm also asking you to do screenshots, because Boeing stock price might have even changed in the last 5 or 10 minutes. So what I want to do is, as close as I can to my screenshot of the share price, use that multiple. Because I don't want to use last week's share price and this week's multiple, because it's an apple and an orange. So let me just go back and check my screenshot, because I'm going to use that. Don't think it's changed that much. But for the EEO, 15.93. And by the way, right now it's at 15.89. So it's 4 basis points off even in the last 5 minutes. All right, but just to sync up with that share price, I'm going to use the 15.93. Is what I believe it was. Let me double check it. 15.93 EV to EBIT, fiscal year 2, just to sync up. All right, 15.93. All right, so here's the thing. I need 4 variables to get this formula to work. I need a tax rate. Sorry, I had trouble. So I need an estimated tax rate. Well, here's the thing. I'm already calculating an estimated tax rate in the ratios in perpetuity, which is the 2023 tax rate, which is M9, I believe, is tax. So M9 off of ratios is my tax rate. So I'm not changing it. I'm just putting it all in one place so you can see where all the data points are coming from. It's already in the model being forecasted. I need a continuing value ROIC. Well, we already got that from the last year up here when we did this key value driver equation. So there's my continuing value operating ROIC. And then I need a WACC. And again, at the top of this page, we have a WACC. So basically, if I put that equation here, which I'm about to do, those are 3 of the 4 variables that lead to the equation. I just need to solve for a G. And the G that I'm going to solve for is basically the G that's right here. Okay, so let's go ahead and do this. So for the model EV to EBIT, I'm going to put this equation into this model equals left paren 1 minus the tax rate times left paren 1 minus the G divided by the ROIC, right paren. Take all of this and divide that by the WACC minus the G. So here's the thing. If these assumptions were to come true, the academic formula would estimate an EV to EBIT of about 14.91. We're seeing 15.93 in the real world today, so we would adjust our model accordingly. Questions? So that means to get to the 15.93, which again is close to this EV to EBIT, 15.93, it's now 8.9, again it's changed, then I need to probably have a little bit higher G than 5.15%, so I don't know, 5.4. 5.56. $5.5. Getting pretty close. $5.51. Now within a basis point. A couple basis points probably good enough. So that's the point. What I've just done, and I'm iterating here, so it might change slightly, because every time I change something, it obviously is going to change the share price. But I've gotten pretty close to the real world multiple in the G academically. So I'm comfortable that somewhere around 5.5% plus or minus a little bit is probably the G I should be using in my model. So as I said last week, is it 3? Is it 4? Is it 5? Is it 6? I kind of ballparked it. Here, I think I've narrowed the range dramatically. And again, it's not whether I agree with it. It's just this is the only way the math works, given some of the assumptions that we put in. So I've gotten to a much more narrow range of a realistic G. So what I've done is back to my model. Okay, now I need to solve for the final $30. I'm not going to dramatically change the G like I did last week to get that $30. I know it must be something else. So let's go back to the ratios. It's probably not the tax rate. It's probably not the WACC, probably not the G. So is it the growth rate or is it the EBITDA margin? Well, if I look at the growth rate and I think about our EIC and just think about historical growth rates, I think going beyond 7% to get that extra $30 is going to be aggressive. So if I had to guess, I think the market's expecting higher margins, even higher margins. So right now we're at 15. I think put in 15.5. 16. 16.1. Now I'm saying you're iterating because if I go back here, my G is 5 basis points off, 1593 for 1608. Because remember, as we change our share price in our model, it will change our valuation, which means our G estimate. But I don't think it's all that far off. So if I were to make this, 5.52 or 5.5, oh, sorry, 5.52. And if I were to make this 16, I think I'm kind of splitting hairs here. It's going to be more like 15.9 or 16. 16.07. Actually, I'm just going to call it 16.1. I'm within $1 at 16.1. But the point is, I know I'm solving multiple variables here, so it's almost like a quadratic equation. But the point of the story here is somewhere around 5 point, whatever it is, 5.5 is probably the right G. And somewhere around, if I go back here, 16% EBITDA margin plus or minus a little bit is what the market's thinking. So here's what I really know about the as is. That basically the market is expecting versus last year about a 300 basis point increase in EBITDA margin to justify the current share price, by the way, of Boeing. That's what the market's looking at, right, for the as is. So it's really about margin. Boeing is an increased margin story. If I go back to what I know about Boeing, it's the 7X7, it's the 787, it's the 737 MAX. I think what the market is giving Boeing credit for is just a lot of new higher margin aircraft, right? I'm not saying I agree with this. That's the point of the target. I think that this is just explaining what justifies the current stock price. That's what we're trying to do for the as is. Questions about how I got to this point? Because you are going to repeat this process on your next homework assignment, because when you do Coke, which is next week, due Monday, individual, not group, you're going to have to estimate a G for Coke following this process. All right, so rather than just randomly throwing out a G for Coke, I want you to iterate through and guesstimate using Coke's trading data, a starting G, and then come up with a more refined as-is valuation. Questions? Hopefully straightforward, so no questions. All right, remember that when you do the as is, this isn't whether you agree or disagree. All right, what we're just trying to do is work backwards. Reasonably work backwards to come up with reasonable cash flow assumptions that justify a valuation. Your opinion shows up in your target. That's where you get your opinion. You get your chance to explain your opinion. So here's the thing. If we were to do the bull and the bear and the target based on the data that I just did, and I had to do the assignment that you did, first of all, what I would say is my target is probably going to be in the hold or the sell range. I think that Boeing is probably at the upper end of the bull to bear range, meaning my bull is not going to be too much higher than this, and my bear is going to be a lot lower than this. Right? And here's my rationale, which is this number that my cursor on is what would worry me most about this valuation. If you look at Boeing's historical EBITDA margins, and you look at how fast they have to approve in the future to justify this current share price, that would make me a little bit anxious. I'm not saying they can't do it, but what I'm saying is just think about this holistically. We are at, 7 to 9 years into a bear market or into a bull market. And Boeing has had a lot of great growth, but I'm saying at some point there's going to be a recession. And with spiking interest rates, it might be sooner than we hope or fear could actually happen. And at some point, Boeing is going to have trouble raising price for airlines that might actually start cutting back orders. And if that ever happens, then suddenly these margins may not be as attractive. Now, maybe I'm wrong. That's why there's going to be a bull and a bear. But what I'm saying is they have to be 300 basis points higher and almost 600 basis points higher than last year's margins in order to justify this valuation at pretty aggressive growth rates. So when I start thinking about my bull and my bear, I think the current target is closer to the bull scenario than it is the bear scenario. So to me, when I would have done this assignment and written my write-ups, I might have been, I don't know what the final number is, but I think 380 to 400 on the high and lower on the low, and where I put them is more downside than upside in terms of Boeing right now. That's what I would fear about Boeing. You may not agree with me, and that's okay. And that's what you would have written up, but nonetheless, that would have been the basis for my assignment that I would have turned in. Okay. So, by the way, where did you guys come in? Did you find Boeing to be a buy, a sell, or a hold? Because that's the next thing is you have to say a buy, sell, hold. You can't just give a target stock price without using the words buy, sell, and hold. So I actually pulled up in one of the earliest sections, one of the submissions of one of the teams, and it didn't have the word buy, sell, hold anywhere in it. And that's a problem. So just to be really clear, you must say buy, sell, hold. You can't just give a number because that's the point of the target valuation. So where did you guys end up? Anybody in the buy side for Boeing? And again, it's perfectly okay to agree with me because we're predicting the future here. And as I look at this, go to the analysts. These analysts in the real world think Boeing is going to be at 413. And there's 20 buys. So the analysts are pretty optimistic on Boeing. They're completely disagreeing with what I just said. Doesn't make me right. I could be completely wrong. There's 20 people who disagree with me. So anybody here was a buy? Everybody was a hold or a sell? Anybody was a sell? You were a sell? You think so? Do you remember your submission? You're looking at your team members like, can we say what we said? You were as optimistic. What made you less optimistic than the analysts?
We put the growth rate lower. I think what was our added? Lower than 400 in the long run, we're like around 400.
You mean our target?
Yeah, our target.
Target.
I think
Our bull or bear was really low.
Yeah. But I'm saying is, but you can start almost laying out the assumptions they need to get to that target, meaning pretty aggressive growth organically and improved margins. Like that's what gets you to these target stock prices that are above $400 a share. And so I'm not saying that Boeing might not be making a case that maybe these planes they're building are more profitable than the last ones. Maybe they're getting supply chain efficiencies that I'm not considering here that they're talking about, right? But that would be the case. Like we kind of have a good understanding that to justify prices above 400, you're going to need some really good margins, because at 16% EBITDA margins, you don't get to $400 share price. They need higher than that, okay? And so again, it's not whether I agree with them. I'm just saying the math says it's going to have to be in that range to get to that share price. And I just worry that that's going to be hard to achieve. Now, I could be wrong, and I'm just naive about Boeing. I just haven't been following them close enough, but that's what we would have to investigate as part of what we would be doing in our recommendation. Okay. It's interesting, Wells Fargo is closer to what we're saying when they're at 370. Or Morningstar at 323, or was it Concord Genuity 350 is probably more of what we've been saying here in class for a little while. And those people are more on the hold side. Again, I'm going to pause. Questions about anything that I just did? Because you're going to have to be able to repeat this for Monday. Okay, so what do you have to do on Monday? As an individual assignment, basically you're going to submit 8 files on Monday. And one of the 8 files is a minimum 250-word paper. This is 4% of your semester grade. So it's actually bigger than the last 2 group projects. Okay, so, because again, I need you guys to do this, but it's probably less work than the last group projects because you should have the models done. But nonetheless, this is going to be an important grade. So, and this is individual, this is not groups. You can't work on this one of your teams. So here's what you need to do. Number 1, you're going to turn in your as-is file, all right, as an Excel. And as part of the as-is, the model has to be fixed, not only with the historical or the forecast data for the unbilled revenue, but it also has to include the G estimator that I just did. So that's going to be part of your as-is. So you're going to do an as-is for Coke, with the G estimator with a more realistic G for Coke. Then you're going to do a Bull, Bear, and a target. And as part of that target, make sure you use the word buy, sell, hold. Again, plus or minus 10% is a hold. Above 10 is buy, below 10 is a sell. All right? And then, again, what the paper is about, so this is file number 5, minimum 250 words explaining those 5 major assumptions and why you're changing them across the models. And then the final 3 files are the screenshots. The DES, the EEO, and the WAC, all right? Because that's the only way that the TAs have a chance to grade you. And remember that you also are going to use it to make sure you take them at the same time. Because, for example, in your EEO screenshot, you're going to have your forward year 2 EV to EBIT multiple, which should be taken near the same time as the stock price, because otherwise they're not going to sync up, right? And again, because you're going to be doing it different days, there could be some volatility in stock prices. So obviously you can have different opinions for the target stock price and to some degree the as-is, depending on where we are in the day of the week. So nonetheless, that's why it's important to include your screenshots. So that's what you're going to do individually. That'll be due Monday at 10 a.m. for all sections. And then on Monday, we'll talk about Coke, and then we'll get more into the multiples part of the analysis, which will then become Monday, Wednesday, and then basically your final homework 8 before the midterm the following Wednesday. So a lot to accomplish in the next week and a half. Questions about any of that?
So when we're downloading the model template for Coke, we assume that it balances.
It should balance. So somebody asked about, is it going to balance? So I'll give you guys a hint. Let's find out right now. So if I go to KOUS Equity and I go to FA, and by the way, let me save this file. So this is the fixed one we just did. This is now Boeing's data in it. And if I want to do Coke, then again, custom, let's go to our model template with, by the way, the field for unbilled revenues in it. So don't forget to have that one in there. Export Excel, that template. Make sure they have any dashes here. Yes, they do. Kill those dashes. Choke your model if you don't. So find, replace those dashes with zeros. So you're going to replace 26 of those. Save that file. I'll call this KO data. I'll put this in my downloads folder. Select all of that. Go to your Boeing file, right click, paste special values. Make sure slide, yep, 81 is in there. Those are all zeros. Good news, balance is right out of the gate. So I chose Coke because I didn't think it was going to not balance. I told you Airbus was screwed up, so we didn't do Airbus. Actually checked Airbus. I was going to do Airbus, but then I figured that I didn't want to throw two difficult assignments at you a week in a row. But if you fixed it, the fixed model should come out balanced the first time. And obviously you got to change the year, you got to change the WAC, put in the right share count, EEO updates, etc. But nonetheless, you'll have a balancing model. You should have a balancing model when you do it. So as somebody asked in the last class, like how often does this happen, like the unbalanced thing, I would say, 1 out of 20 or less. It's very infrequent. Just so happens to be that I picked one, but it is extremely very infrequent. So most of them are going to be like Coke, where we captured the fields, everything will flow through, and it'll be a lot easier to do. So this one should be a pretty straightforward assignment. The major difference is the estimate of the G. That's going to be the new thing that you didn't do before. And as I said, this is more individual. So if your group has been doing it, you need to individually figure out how to do this as well. Okay, so make sure you have a file to do so. Okay, I will see everybody on Monday during class. And again, submit by 10 a.m. Monday morning, and then we'll go from there. Yes?
Can you scroll up to the top?
Have a good weekend.